Hello traders, this is John Kicklighter, Chief Strategist for dailyfx.com. I'm here with a Forex strategy video to answer a question or a topic that people have asked about repeatedly and consistently for the past couple of weeks, and that is the Swiss franc. Now, I've shied away from this currency and generally the currency pairs that it represents because there is a strong correlation between the, let's say, dollar Swiss and euro Swiss. All right, that relationship is actually reinforced because of the euro's connection to the Swiss franc. In effect, the very low amplitude that you get on the euro Swiss, since we've had the S&B's floor put in at around 120, we really haven't been able to get much more than 600 pips above that floor, creates a kind of connection between these pairs in which you don't really see, let's say, a euro dollar deviate that far from a dollar Swiss. So most of the time, when I'm looking at a dollar Swiss, I will simply look at the euro dollar and decide whether I would prefer to trade that particular pair. All right, but there is an interesting debate. There's an interesting argument to make about the dollar Swiss and the Swiss franc in general in this relationship to its Euro-Swiss underlying counterpart, because why is the Euro-Swiss so important? The Euro-Swiss is so important because this is essentially the most liquid exchange rate for the franc. The Swiss economy is so heavily connected to the Eurozone economy for trade and financial capital flow that there is essentially a very substantial jump between the liquidity of this particular pair and its next most liquid pairing. So, knowing that this relationship exists, this fundamental connection, we also have to consider what this long period of congestion down here at this 120 floor. For those that aren't familiar, we had a very substantial appreciation in the Swiss franc through 2011. All right. And the Swiss National Bank decided to intervene aggressively on behalf of this particular currency pair, and then subsequently put in a floor at 120. We came to test that floor for a long period of time and essentially stalled there for an even longer period. And ever since then, we've not really been able to get much further off of this floor. But knowing that there is a floor down here, this shapes a very interesting argument. How does this floor, let's say on Euro Swiss, impact the dollar Swiss? Does this equate to a floor like we had on the Euro Swiss? And you can apply this to almost any other Swiss-based cross, because the Euro Swiss is inevitably going to be that pivotal comparison. All right. So there's a couple things that I want to discuss on this front, and it might get a little complicated, but we'll try to illustrate this as much as possible. Now, the first thing to understand is that when we have three currency pairs, there's something called triangular arbitrage. When we have, let's say, a dollar Swiss, okay? When we have a dollar Swiss, we should be able to make with the Euro Swiss and the euro dollar. All right, so what you're doing is you're using those two pairs and you're making what we call a synthetic dollar Swiss. All right, so when you combine those two pairs, euro dollar and euro Swiss, you're negating the influence of the euro itself. Between the synthetic price that we get and the actual dollar Swiss exchange rate, we should be very close to what we call fair value. Those two should be very, very close in pricing. Why? Because there otherwise would be what we call an arbitrage opportunity. I would be able to, if the market-based price, if this dollar Swiss was cheap compared to the synthetic price, I can buy the cheap actual market price, and I can go essentially what would be short on the synthetic. And eventually I would expect those two to come back to a similar price, a fair value price. Now, this is the illustration of that. The light blue dashed line, which is very close, as you can see, to the dark line, is is a reflection of the synthetic price. Right? The dark blue line is the dollar Swiss price. As you can see, they essentially follow exactly the same track with very minor deviation. That's exactly what you would expect to see. if there were an opportunity to get what they consider risk-free profits from a mispricing of that magnitude, it would be quickly gobbled up. And we have seen in the past that there have been some very significant deviations from this relationship, but they are quickly closed. All right? And even during the intervention effort from the Swiss National Bank, during this big rapid move here, we really didn't get much in the way of mispricing. Very interesting. All right. Now this is important because when we look at the performance of the dollar Swiss, we can see that its synthetic pricing is very closely held. Now what happens though if we get to a Euro Swiss where it's getting back to that floor? There is a natural floor here on this Euro Swiss, or an unnatural floor. It creates some interesting deviations from what should be a natural pricing. So what happens if we get down there and other currency pairs start to follow suit? The Swiss franc in general starts to advance. If the Swiss franc starts to advance, the Swiss National Bank will certainly act on behalf of the Euro Swiss. This is their target currency to keep that 120 floor. That is their mandate, their confirmed mandate. But if we have other Swiss-based rates that are also appreciating aggressively for the franc's benefit, then we're going to see that they're probably going to see some of that stimulus as well. But more importantly, the follow-through or the spillover from the effect here is likely to find its way into other Swiss franc-based pairs. Now, this doesn't mean that the dollar Swiss can't continue down. It can. But much of that consideration, much of that relationship is to be made through an exceptionally strong euro. All right? Now, the correlation between the dollar Swiss and a euro dollar, all right, I put this in green here. Now, to give you a sense of how related those two pairs actually are, we can look at this. This is a graphical representation of it, where you just have the extreme negative correlation. When it's down at a negative 100%, it means they essentially move in tandem over that time frame. I think this is I believe I have a 3-month rolling correlation here. All right, so in essence, the euro dollar and dollar Swiss move pretty much in lockstep in the opposite direction. Why? Because the Swiss is on the second currency in the pairing. The euro is on the first currency in the pairing. So they should move in opposite directions. So in essence, the euro is treated very much like the franc and vice versa. All right. So we have a strong relationship here, and if that strong negative relationship is maintained, then we would expect a strong advance in the euro. If we have a continuation here, we break that 138.50 top, continue on to 140, then the strengthening of the euro, given the exceptionally tight correlation to the Swiss franc, should in turn lead the franc materially higher. All right, so we would see this drop below this floor. Now, we come back to that nuisance of a floor on Euro Swiss at 120. The dollar Swiss and Euro Swiss are not as strong a correlation as the negative correlation between the euro dollar and dollar Swiss, but as you can see, it's pretty decent. All right. Now, if we start to see that the euro dollar's appreciation ends up helping or creating a bid for the Swiss franc elsewhere, it might not pull the Euro Swiss down and thereby force the hand of the Swiss National Bank to intervene on behalf of their currency to keep up the Euro Swiss exchange rate. But that pressure will be there. Now, looking forward, I'm not that bullish on the euro going into the first quarter of 2014 and potentially even further beyond. I'm also pretty confident in the Swiss National Bank's commitment to keeping up that 120 floor. So that combination of factors is likely to either one way or another put pressure back on the Swiss franc from its very aggressive appreciation. I also happen to have a pretty positive expectation for the US dollar going forward, particularly against the Swiss franc, who's unlikely to be able to lift rates anytime soon or even discuss it because it would contradict their euro Swiss floor effort. But the dollar is likely to see some positive implications of a taper, whether it happens in December, January, March. All right. So when we put it all together, there is a very good probability, a very decent probability, that the dollar Swiss will start to find its way higher. Doesn't mean it has to be right now. This is not a situation where I think it has an immediate timing. I don't think it's an immediate trade. As you can see, the euro dollar and dollar Swiss are still moving exceptionally in lockstep, just in opposite directions. So if the euro dollar can overtake this October swing high, the dollar Swiss is going to make new lows. Right, because of that relationship. However, the more aggressive the push becomes, the less likely that it is for continuation. So I will be watching this dollar Swiss, and I do think it has great potential over or through at least the first half of 2014 of seeing significant appreciation. This might actually make it into one of my top 2 trades for 2014. So keep an eye out for that. We'll try to post it in the next couple of weeks. All right. So this was purely a strategy video that I made because there were so many requests and so many comments about this in Twitter and in my email. So if you do have a request for a specific topic in the strategy videos, feel free to let me know them. I'd be happy to take a popular topic and clarify for you guys. Thank you for watching, and we'll do our next Forex strategy video tomorrow.